Ever wondered how international business thrives without crippling double taxation? Double Taxation Conventions, DTCs, are the unsung heroes, providing a vital framework for cross-border economic activity. This guide will demystify these crucial agreements, offering essential insights for taxpayers, businesses, students, governments, and accountants alike. Imagine a pivotal international summit where delegates from two nations, Eldoria and Pacifica, convene. Their mission: to formalize a new Double Taxation Convention. This treaty is more than just a document, it's a commitment to fostering economic cooperation and ensuring tax fairness. The signing of such a treaty marks a significant step in international relations. It establishes clear rules for taxing income and capital, preventing individuals and companies from being taxed twice on the same income by different countries. This predictability is vital for global commerce. The treaty begins with a preamble, a foundational statement of intent. It articulates the shared desire of both countries to promote economic cooperation and eliminate the adverse effects of double taxation. This sets the tone for the entire agreement. For businesses and taxpayers, the preamble signifies a commitment to a stable and equitable tax environment. For governments, it underscores the mutual benefits of collaboration in tax matters, enhancing transparency and reducing disputes. Articles 1 through 5 lay the groundwork, defining the treaty's scope and key terms. Article 1 clarifies that the treaty applies to residents of both contracting states, ensuring its reach is precisely understood. This is crucial for determining who benefits from the treaty's provisions. Article 2 specifies the taxes covered, typically income and corporate taxes, providing clarity on which levies are subject to the treaty's rules. Article 3 then offers general definitions for terms like person, company, and tax, ensuring consistent interpretation across jurisdictions. Article 4 defines resident, a critical concept for determining a taxpayer's primary tax jurisdiction. This article often includes tiebreaker rules to resolve cases where an individual or entity might be considered a resident of both countries under their domestic laws. Finally, Article 5 introduces the concept of a permanent establishment, PE. This defines when a business operating in another country establishes a sufficient presence to be subject to tax there, such as through a branch office or a construction site exceeding a certain duration. Understanding PE is fundamental for businesses expanding internationally. Articles 6 through 21 categorize various types of income, assigning taxing rights between the two states. For instance, Article 6 addresses income from immovable property, typically granting primary taxing rights to the country where the property is located. Articles 7 and 10 cover business profits and dividends, respectively, often allowing for limited taxation in the source country. Articles 11 and 12 deal with interest and royalties, frequently providing for reduced withholding tax rates to encourage cross-border investment and innovation. Other articles cover capital gains, Article 13, employment income, Article 15, and pensions, Article 18, among others. Each article provides specific rules to prevent double taxation and allocate taxing rights, offering predictability for taxpayers and businesses engaged in diverse activities. Article 22 serves as a catch-all provision for income not explicitly covered elsewhere in the treaty. It ensures that all forms of income are addressed, preventing gaps that could lead to double taxation or tax evasion. This article typically assigns residual taxing rights to the resident state. This provision is important for taxpayers with unusual or miscellaneous income streams. It provides a clear framework for how such income will be treated, contributing to the overall comprehensiveness and fairness of the treaty. Articles 23 and 24 outline the methods by which double taxation is eliminated. The two primary methods are the exemption method and the credit method. The exemption method means income taxed in one country is simply not taxed in the other. The credit method allows a taxpayer to credit the tax paid in one country against their tax liability in their country of residence. These methods are crucial for ensuring that the treaty's primary objective, eliminating double taxation, is effectively achieved for all taxpayers. Articles 25 through 27 focus on ensuring fairness and fostering cooperation between the tax authorities. Article 25, the Non-Discrimination Clause, prevents one country from imposing more burdensome taxation on residents of the other country than on its own nationals in similar circumstances. Article 26 establishes the Mutual Agreement Procedure, MAP, allowing competent authorities to resolve disputes arising from the interpretation or application of the treaty. This provides a vital mechanism for taxpayers to seek relief when they believe they have been subjected to taxation not in accordance with the treaty. Article 27 facilitates the exchange of information between tax authorities, crucial for preventing tax evasion and ensuring compliance. This cooperation enhances the integrity of the international tax system and supports fair revenue collection for both governments. The final articles, typically 28 through 30, address diplomatic agents, territorial extension, and the entry into force and termination of the treaty. Protocols and annexes often accompany the main treaty, providing further clarifications or country-specific rules. These provisions ensure the treaty's practical application, its adaptability to changing circumstances, and its formal legal standing. They represent the culmination of detailed diplomatic negotiations and legal drafting, reflecting a comprehensive approach to international tax governance. A Double Taxation Convention is far more than a legal document. It's a dynamic blueprint for fairness, clarity, and cooperation in our globalized world. For taxpayers and businesses, understanding these treaties is essential for compliance and strategic planning. For students, they offer a window into international law and economics. For governments and accountants, they are indispensable tools for effective tax administration and advisory. We urge you to familiarize yourself with the DTCs relevant to your international activities. Consult with tax professionals, review official government resources, and leverage these treaties to ensure compliance, optimize your tax position, and contribute to a transparent global economy. Your proactive engagement strengthens the framework for international trade and investment.